The other concept, and this goes back to the strong balance sheet. I'm good. I got the water. There's a concept I like to call weak money and strong money. And you always want to be strong money. You never want to be weak money. Now what's strong money? You never want to be in the middle of a crisis. You never want to have you never want to have a margin call. You never want to have to pay off your loan in the middle of a crisis or have your house foreclosure. If you are weak money, you are going to be in a bargaining. You're going to be put in a bargaining position that you're going to be a forced seller. Now, those people with strong balance sheets, companies with strong balance sheets, people with strong balance sheets, can take advantage of that weak money. The people with the strong balance sheets in 2008 and 2009 are getting paid at the end of 2009 and getting paid this year for the investments they made back then. And so those people, like, if you are a large financial institution like Citibank, you were automatically weak money. You had no choice except to raise money. If you were Lehman or Bear Stearns, leveraged 30-to-1, there were no buyers on Sunday afternoon, right? There's nothing they could do about it. Okay, I mean, you know, could have if there was no forced person selling, you know, if there was no regulator breathing down their door, and they let the assets ride themselves out in terms of not mark to market, but the actual cash flow from the securities, would they survive? Well, they would have had a better chance. But because the market made the regulators and the investors nervous, they cut off their overnight market, and they were done. Okay, so you never want to put when you guys are in charge of organizations, or whether it's your personal balance sheet, you never want to use using margin and, you know, shorting or anything that will put you in a position in this darkest day where you are a forced seller or you're forced to do something that you don't want to do, then you're the weak money. And if you're sitting there on the other side and you have a balance sheet and you can pick apart the deals you want because you know you're going to make money when the market settles, and whenever the market settles in 6 months, then you're the strong money, and you always want to be strong money. That's why CP&E Partners, you know, we don't buy companies that are over-leveraged in general. We don't use margin ourselves, and we always, I guess we always do like to have a little bit of cash, but we also like our companies to have a lot of cash on hand. And it's, you know, it's as simple as that. So, not that complicated. Yeah.
When you're using, like, the pick a stock, those first two things, the strong balance sheet and the low value ratio,
yeah,
are you running it against what, the industry, like the industry comps, or are you looking, you know, just like small peer group?
Right. That's a good question. Who do I compare it to? Well, there are two things you want to compare a company to. You want to compare it to its history, its own history, and in terms of valuation and in terms of financial ratios, like day sales outstanding, or if it's a insurance company, insured days, reserve days outstanding, or inventory turns for manufacturing companies. But you want to compare it to its history, and if one of the ratios are off, you want to understand why it was off. Was it higher one year? Why did it spike that year? If it's lower, was there a depression? You also want to compare it with its competitors. There was a time in my life where before I started my firm, I was working for a company called Tyndall Partners, and we were short McAfee, which was an antivirus company. It had a very promotional owner that back in the mid to late 90s. So I knew the antivirus business. As a short seller, I had contacted all the players, Symantec, Trend Micro, and a couple others. So I knew the industry really well. And there was a time there in late 2000, I think it was December 2000, like one of the last trading days of the year, where all the shenanigans at Network Associates, the accounting tricks that they were using, finally caught up to them. They fired the CFO. Stock goes from 10 to 3. And this is in the last week of December. So you have two things. Talk about forced seller. Okay, you have two things working against you there. One, no investment manager wants to go into their investment committee meeting owning this thing that's in a scandal now, right? So that's the first thing. And then you have a second forced seller because of the tax losses. Everyone wants to just dump it to realize the tax loss because it's the end of the year. And I knew this business. And, and the other thing is, it's a software business, so it generally doesn't burn cash, even if they had bad accounts receivable. It's a cash business. Okay? Software companies just produce cash, basically. And number two, I knew what the normalized margins were. And it wouldn't show up in this company for a year at least, because they had cooked the books. But I knew it wasn't going to go bankrupt because they had lots of net cash. They had like $200 million in net cash. And if you looked at what Trend Micro was spending on its R&D, Trend Micro was a Japanese antivirus company. And antivirus is like you need 30 engineers in a room to come up with the solution of antivirus. Some antivirus hits the world. Some guy sits around for a half hour, comes up with a solution, puts it on a website, and everyone downloads it. You need about 30 engineers to do it. Okay, so and I knew that business. And I looked at Trend Micro was a Japanese company. We looked at what they were spending on R&D. It was $30 million a year. And Network Associates is spending $200 million a year. What is going on? I mean, you only need 30 managers. So you look at Symantec. You knew they had 30% margins. The Network Associates and Symantec are basically the Coke and Pepsi of that business. And so you knew that the earning power was going to be there eventually. Maybe not in the next, certainly not in the next 6 months. Maybe a month from now. Maybe a month. Maybe a year or two from there. You would have to wait a year or two later. But eventually, if they managed the company right, they didn't have to spend $200 million on R&D. They could get away with spending $40, $50 million bucks and still have the best R&D in the business. You realize what type of value was there. It was like I forgot the time the market cap was, but it was probably at $3. You're probably buying it at 1 or 2 times normalized EBIT, basically. And that's an example of something with a strong balance sheet. You're just waiting around. A lot of volatility in the stock price. Right, it goes from 10 to 3 in one day. But the balance sheet's very strong, so it's not going to go bankrupt. But you have a lot of forced sellers, right? Because they're nervous. And it's not because of a leverage problem. It's just because they don't want to look dumb in front of their committee, and they have a tax reason to sell it. So.
Let's say Citibank, you got this annual report this thick. Let's say you want to analyze it. How do you start?
I wouldn't. It's too difficult for me. The thicker the annual report, I was explaining this before. If the footnotes has over 100 parts into it, it says everything and it says absolutely nothing. Just pass. There's 1,000 different other things out there to study.
So you just bypass the insurance industry and the bank industry.
How big? I mean, I buy S&Ls that are, $1 billion in assets that have a very mundane mortgage home loan business. The ROE is maybe 5 or 6%, maybe even lower, maybe 3 or 4. But they have 20% equity to assets compared to Citibank, which probably has 4 or 5. And they're trading at 60% a book. You can't tell what's going on with these large. The larger the footnotes are, you're never going to tell. You could read the same page over and over again, and you ask for help from the IR. They don't know what's going on half the time, and they don't have time to hold your hand and walk you through it. I mean, you could generally say that, okay, Citibank's credit card business is worth this much, the retail business is worth this much. You add it up all together, and you take the preferred debt out, and you just pray to God that the interest curve will be steep like it is now, and that the Fed will bail them out in terms of the interest rate curve, which is what happened in '91, and I think that's what's going to happen now. And you'll probably make like 3 or 4 times your money. So, but if it's, you got to recognize, like I own Bank of New York, right? I'll never be able to analyze all those footnotes. Okay, it has $23 trillion. It's the largest custodian in the world. It's where everyone keeps their stuff, right? $23 trillion in assets. It's a black box. Even if you understood it, there's so many things that can go wrong. You'll be the last one to find out.
There was